And good morning, everyone. Welcome to our Retirement Income Planning Process webinar. I'm Ryan Urban with Alpha Financial here in Colorado Springs. I see that we have several guests with us this morning, so we'll go and introduce ourselves. I also want to let you know everyone is on mute, and so if you have a barking dog or a phone that goes off, that's just fine. About us very quickly, for those of you who are not clients, Alpha Management is located here in Colorado Springs on Centennial Boulevard. Our office line is 719-358-7116. Our site is alphafinancial123.com. And of course, anytime you can email me, and especially after this webinar, if you have questions, specific questions about your situation, feel free to email me. I'm never at a loss for an opinion, so I'll be happy to respond to all emails. Our excellent staff is there, Diana and Shannon, so the cheery voice that you hear when you call our office will most likely be one of them. And again, we're right here on Centennial Boulevard in Colorado Springs. So let's get started. The income planning process, I think, makes a lot of people nervous, and I think a lot of people think that this is a very complicated process. They just don't want to do it. I mean, ideas of Excel spreadsheets and having to do a bunch of paperwork drops into their mind, and they just put it off for a while. They think it's going to be very confusing, very complicated, and you might be surprised. It just isn't that way. With patience and a little bit of guidance, it's not too bad. In fact, we just have 6 questions that we ask when we're looking at the income planning process. And what I mean by the income planning process is, what is your retirement income going to look like? I think a lot of people go through life assuming that, well, I'm not really going to know until much later. But, the fact is, you really can plan some of this out. So here are the 6 questions we're going to ask. First of all, how much money do you have saved today, right now? Now, what we will not do is count things like emergency funds, cash laying around. We're thinking more about, regular investments, plus 401ks, IRAs, SEPs, whatever it is that you're in. That's our first question. So we drag out the statements, we look at them very carefully, and we see exactly how much you have saved towards retirement right now. The second question we're going to ask is, how long is it going to be before you retire? And we know that you may not know that, and you'll see on the back end that we do provide some flexibility here. But let's say you're 40 years old. Well, you're probably thinking you're going to work until regular retirement age, and that might be anywhere from 65 to 70. And that might depend on how much you enjoy your career. Or you may be coming in for a landing. You may be 60 or 62, and you're trying to make some decisions on, well, when can I retire? I'd like to fairly soon. Okay, so if you are coming in for a landing here, it really is time to look at this, because you may decide that A, you can retire earlier than you thought, or B, you may have to work a little longer. But this is the time to find out. The next question is going to be, how much are you contributing monthly? So if you have an IRA and or a 401k, if you have any kind of retirement plan, get your pay stub out or get your checkbook out or your statements, whatever you need, and let's find out how much you're contributing monthly. So, and it's very simple. For example, last year you put away $3,000 into your IRA. We're going to say right now you're averaging about $250 a month going into your plan. Now, as we do this planning process, you may find out that maybe you ought to tweak that up a little bit and go from $250 a month to $300 a month or $350. That's what this process is for, so that you can make tweaks now so that you can retire the way you want to later. The next question is, are you getting employer matching, and how much? This is really important. If you have a 401k, there's a pretty good chance that your employer is also matching the numbers, the money that you're putting in there. So what we'll do then is we'll look at your pay stub or your statement for the previous year. We'll see how much they matched, and we'll simply divide that by 12, and we'll say they're matching this much per month. That's a very important number. Fifth, what are your Social Security benefit estimates? Now, Social Security is a presentation on its own. But what you can do for the purposes of this income plan is go to socialsecurity.gov, and you'll be able to estimate your Social Security income at ages 62, 66, and 70 based on where you are right now. So it's socialsecurity.gov. If you have any questions or need to be pointed in the right direction, just email me, and I'll be happy to do that. This is going to be very, very important. Again, this whole Social Security thing, I'll do another webinar on this by itself, because this kind of planning, you might be surprised. You might be surprised at how easy and how much money you might make in Social Security. And then finally, we look at any other income that you will be having in retirement. So that might be something like a pension. It might be real estate. So if you're renting, you have a rental real estate property, or 2 or 3. Well, what we have to do is we have to estimate what your net income is going to be, after costs of running that real estate, for example. And then we also look at, well, how long is it going to be before that thing is paid off? Because when your mortgage payments are gone, whether it's your personal mortgage or a real estate investment property, well, you've just given yourself a huge raise because those mortgage payments are gone. So there you are. That's it. Those are the 6 questions that we ask when we're doing the income planning process. So let's just run through it. There's simply 2 steps to this. And we're going to talk about Al and Maria, and we're going to say that they're looking at doing income planning. Well, I just have the same questions for them. We're going to say that they're both 55, and we'll say that they're both 11 years from retirement. Going back to Social Security, a lot of people don't know this, but full retirement age for Social Security is somewhere between 66 and 67, depending on when you were born. But you can start Social Security earlier, as early as 62. The thing is, though, your benefits are going to be decreased, and you may be penalized if you're still working. So again, that's another conversation. But we'll just say that they're both planning to work until full retirement age. Right now, they do have current retirement savings. Al has about $148,000 in his total in his accounts, and Maria has about $111,000 in hers. Total monthly contributions. Now remember, this includes both what they're contributing personally and what their employer is contributing. So we'll say $620 for Al and $500 for Maria. Now this is where it becomes as much of an art as a science. How much are they going to make in returns between now and retirement? Well, obviously, we don't know for sure, so we have to make some projections. And I use 6% in this case, and I'll explain it. If they were 30, I would increase that projected investment return because they're longer-term investors and they can be more aggressive. If they were 60, I would drop that down to 2 or 3%, only because I would rather shoot low. So that is part of a conversation that you and I have. And it's not just how many years you have before retirement. It's also having to do with your risk tolerance. So for the purposes of this presentation, we'll say 6% projected return for both of them. That means at age 66, when they're planning to retire, Al will have a nest egg of about $403,000, and Maria will have a nest egg of about $309,000. Now, how do we know how much money we're going to take out of our nest egg? Our biggest fear in retirement is outliving our money. In other words, running out of money in retirement. So I get this question all the time. How much money can I take out of my nest egg for retirement income while still being comfortable and confident that I'm not going to run out of money in retirement? Well, the rule of thumb is not mine or Alpha Management's, it's the industry, and that's the 4% retirement income rule. What it says is you take out 4% first year for your retirement income. You can add COLIs, cost of living increases annually. In real life, people kind of forget to do that, and they'll raise it later. But you can give yourself cost of living increases to keep up with inflation. Well, the money will then be invested in such a way that essentially you're living off the interest. And the neat thing about that is that means that your nest egg is not in decay. It's not going down over time. The goal here is either to keep that nest egg where it is or increase it. Now, another nice thing about that, remember that the nest egg is totally liquid. So, if you want to dip into it to buy a boat, that's perfectly fine. But the nice thing otherwise is that those nest eggs then are essentially a life insurance policy for the spouse, because if the first spouse predeceases, if they die first, that nest egg has not been in decay. So that means that the spouse will be able to just inherit that money. Now, again, that's a short version, but that's what the 4% retirement income rule is. So for Al, that comes out to monthly about $1,343, and for Maria, it comes out for about $1,032. So what other things do we have? Well, their estimated Social Security income. So they've both gone online, and Social Security has told them that age 66, their income there will be $2,508 for Al and $2,290 for Maria. A lot of people have a really shocked look on their face when I show them those numbers. That's much higher than they're expecting. So there you go. That's going to be their income from Social Security in retirement. And of course, with Social Security, you also get COLIs, cost of living increases. Turns out Maria has a pension from one of her jobs over time. Now, Al does not. He's worked without a pension for these years, and Maria has one at $758. So that also, we're going to add their rental property. And we're going to say that their average profit, or properties, we're going to say their average profit per month is going to be about $1,000. So I just split that between the two of them. Well, that gives us a total projected income for Al at $4,351 and for Maria at $4,580. And that's it. We just plugged in all of the data points. We made a couple of projections, but that's really about it. So let's bring that number up here. Their total gross income. Now remember, gross means before taxes. We're going to throw a little curveball in here, and we're going to say that $8,679 of that income is coming out of a Roth IRA that one of them has. Well, on a Roth IRA, that income is not taxable. So we're going to say their taxable non-Roth Roth income is $98,493. We'll say federal and state taxes at 22%, and that's another conversation that we're going to have. We'll just, for the purposes of this, say $21,668. That means their net income, and then we fold the IRA income back in. Net income is going to be $85,504 per year for the two of them, or about $71.25 per month. Great. Maybe their budget in retirement, and this is the other part of the retirement income planning process, we have to look at what your outgo is going to be. The income is only half the chart here. It's only the left side of the page. The right side of the page is going to be your budget. Well, their desired budget might be $5,500 a month, or it might be $3,000 a month. Well, if their net income is $71.25, they're in great shape. They can take an extra couple of trips per year, or put more away, or set up college funds for their grandchildren, whatever it is they want. Or their desired budget might be $8,200. Well, if that's the case, we've got some decisions to make. What does that mean? It might mean, well, we have to contribute more at work. We have to create a larger nest egg. It may mean that we have to work another couple of years. It may mean that they have to do something with their rental property. It could be anything. And again, once that's where we're drilling down after we've seen these numbers. And believe me, I've seen quite a few people whose desired budget is over $100,000 a year. And so, sometimes there are decisions that have to be made. Okay, so that's the first part of this process. There is your projected net income in retirement, and then we're going to compare that to their desired budget. Now, what they may do is they may say, well, our desired budget is $7,000 a month, but we could live on $5,000. Well, okay, then we'll have that conversation. That's all this looks like. All right, step two is a little different. Okay, now Al and Maria both are going to have a few things to think about. If Al dies first, Maria's income is going to drop by $2,290 per month, because she is going to lose the lower of their two Social Security benefits. So we have to think about that. What does she think about dropping $22.90 per month? If Maria dies first, Al's income is going to drop by over $3,000 a month because he's going to lose her Social Security and her pension income. What are we going to do about that? We have to look ahead. What if one or both of them need long-term care? Well, there's a 70% chance that at least one of them will need that. Now, a lot of you know, many years ago, I was a director for a large home health care company. And I can tell you, beyond a shadow of a doubt, that very few things burn through wealth faster than the need for long-term care. And many of you have had this happen in your own families. Well, you have to plan ahead for this. Do they want to leave money for their heirs or to charity? And that's another conversation that we had. Another conversation is, in what direction do they think income taxes are going? And I'm going to tell you, in case you don't already know, they're not going down. A pretty good chance they'll be going up over time. Well, here's what I have to deal with this. And I mean literally, here's what I have and here's what my wife has. Long-term care insurance is another conversation altogether as well. I'll give you the punchline there, though, is I don't care for it that much. It's expensive. You may not need it. It's complicated. So what my wife and I have are life insurance with what are called living benefits. What this does is it provides, first of all, a tax-free death benefit to your spouse or your heirs. Now, remember, when people get life insurance, they need to go, well, what is this for? If it's going to be for income replacement, then you have to remember the 4% rule. So if you're trying to completely replace a spouse's income, you have to multiply that income by 25, okay, for the 4% rule, and that'll tell you how much life insurance you need to replace their income. However, the nice thing there is it does provide a tax-free death benefit in most cases. So an example, replacing Maria's $3,000 a month with the 4% rule, a death benefit required would be about $914,000 in coverage for Maria. Just numbers. It's very simple. However, what do living benefits mean? Well, that allows you to access your policy's death benefit if you need long-term care. So you're able to tap into your life insurance policy while you're alive if you need it for long-term care. I've had this happen with clients, and to say it came in handy would be an understatement. This is a really good benefit. However, and remember though, that if you didn't need the long-term care, you have the life insurance. So you're covered in either direction. Now, these can be structured so that Al and Maria can minimize their exposure to higher income taxes in the future. These things, another nice thing about these is they don't cost anymore. There are only a few companies that do these, and they don't cost any more than traditional life insurance. So you can get the cheap, term life insurance, 10-year, 20-year, 30-year, that has these living benefits. Or if you are a person who's interested in permanent life insurance, such as universal life or whole life, same thing applies. So, this is a very good thing to have, but you have to cover yourself for long-term care. There's a 70% chance, if you're married, that one of you is going to need it. And again, this is available in 10, 20, 30-year low-cost term or permanent coverage. So that's step two. That's the second part of the process. The first part of the process is coming up with that income and comparing it to what your budget might look like in retirement. The second part of the process is protecting the whole thing and looking ahead and seeing, well, what kind of income, what kind of money are we going to need if? Because the if is probably going to happen. And it's not necessarily fun to talk about. It's certainly not as fun to talk about as investing, at least for me, but you still need to do it. So that is your retirement income process. Let us know if you have ideas or requests for future webinar topics. There's our contact information. You can reach us at any of those numbers. Our office line here in town, 719-358-7116. You can stop by alphafinancial123.com, learn more about us. If you have questions here, you can email me either there, through that email address, or through the website. And I look forward to your questions. Thanks very much for joining us, and we'll see you soon.